Headlines do more to terrify than clarify. That's one of my favorite sayings that I heard. I can't take credit for it, but I think it's a great saying. You're probably seeing a lot of different headlines about what's going to happen with the real estate market in 2026, and most of them probably conflict each other or contradict each other. Are prices going up? Are prices going down? What's inventory doing? What are rates going to do? So those are all questions that are coming to mind. And what I wanted to touch on here today are three topics that I think are important to anyone thinking about buying in 2026 here in the Los Angeles area. So what actually is happening with prices and inventory and buyer demand? And then what's this insurance thing that people have been hearing a lot about, but how does that really come into play when you're thinking about buying? Let's talk more a little bit about that as well. So the first thing I wanted to get a little deeper on, so just a little bit of a roadmap of what we will cover here in this video so you know what to be on the lookout for. We're going to talk initially about prices, inventory, things like that, what's happening with the real estate market. We're going to go into a little bit about what's happening with buyer demand. Where is it now? Where's it been? Where we think it's going? Because that's also going to affect the first conversation of what's happening with prices. And then the last thing we're going to talk about that I mentioned a little bit ago, you definitely want to stay around for this. It's going to be our last topic, and that's talking about insurance. So buying a home, how does that factor into your price? What do you need to do? What do you need to be on the lookout for when you're buying the home? What are you going to need to do once you do buy the home? And what are some ways that maybe you could save some money on insurance, things you could do to the home that will help you save on that insurance premium, because those rates have gone up quite a bit recently. That way, if you're thinking about making a purchase here in 2026, you're going to make a smart, information-based decision and not be scared by all the headlines that are just trying to terrify. So let's start with the first topic. In this section, I just wanted to kind of talk about the market in general, just kind of go off the cuff here a little bit and just talk about what I'm seeing, what's happening here in the trenches and day to day, and talk a little bit about where we've been, where we're going, where we are currently, and where we're going with some of the things like prices, inventory, rates, all of that. And of course, I don't have a crystal ball as much as I wish I did, but I don't have a crystal ball. So, this isn't, I'm not guaranteeing, this is no advice. It's just my thoughts on what's happening. I talk to a lot of people in the industry. I read lots of articles. So I'm basing it on what we think is most likely to happen. There's always worst case, there's always best case, and then what's most likely going to happen. So what I wanted to get into first is just kind of where we've been. So in the spring selling season this year, we had one of the slowest, we actually had the slowest selling season in 13 years in the nation. We felt that here locally as well. Very slow in June and July. Things really actually started to pick up in August, which is a lot of times a slow month for us. So things picked up in August. We saw pretty good activity throughout the fall. Of course, here we're at the end of the year, we're in the holiday season. There's always a bit of a slowdown. You get a little bit of a rush with people wanting to sell before the end of the year. Some people wanting to get in before the end of the year. I just opened up 2 new escrows. So I've seen a little bit of a flurry here right at the end. But in general, we see fewer homes on the market. People are just kind of saying, okay, let's wait until after the holidays. I do have a couple of those listings that are also coming up as well that they don't want to go on during the holidays. They want to be in their home, or, then buyers are, distracted. They want to make sure they hit the market at a time when there is more activity and things going on. So want to just kind of give a sense now, where's it going? So that with them waiting, that is part of where's it going. And that is my recommendation. If someone doesn't have to sell right now, I'm saying at least wait until after the first of the year. And that's what I've done with a couple of my clients. So we're going to wait until after the first of the year. Activity typically picks up. We are expecting it to pick up. This next section, I'm going to talk about some buyer demand and what's happening there, what we're seeing with people with mortgage applications and some of that. So I'll get into that. But with that, I think waiting until after the first year is definitely a better thing if you're selling. And as buyers, just know that's when you are going to start to get more competition. So one thing I always touch on, if right home comes along now, don't wait. They don't come along all that often, and not as often as they used to, because inventory is also down. And we don't expect that to go through the roof any day soon either. So that's a little touch on inventory there as well. But I say, if the right thing comes along now, don't wait for it. Don't jump on it. People are asking, do we think prices are going to go down? I don't think so. Not with where rates and demand are starting to head, but it always could. But even if it would, the right home isn't going to come along right at the bottom of the market. So you can't time it. We usually don't know we're at the bottom until we're months past it. So you're going to be waiting for that. We do know we've hit the bottom and we're past it. Now you're on the upswing. There's going to be more competition. So it's just going to be more difficult. Prices are going to be going up at that point. So you may not do any better than if bought now, even if prices did dip a little bit. Because right now you're going to have less competition. You're going to be able to have all your contingencies. You're going to be able to do more with property, and you're going to be able to look into more inspections and things like that. Maybe even negotiate a little bit. Most likely I'm seeing a lot of that right now. So you may not get that. You'll still maybe have some. It won't be crazy like the pandemic, but you are going to have more competition as accepted. It's just the way it is. So right home comes along now and it's a little bit slower. It could be a good time to jump in. And I always recommend the right home. Don't wait. You're going to be in it for 8, 10, 15 years. Who knows? So don't wait a few months to take the chance of losing what could be a great home. There's going to be others that come up, but don't take that chance. So where we're going, I think, going into the new year, I think buyer demand is going to pick up. I do think prices will start to tick up a little bit. The Fed just dropped dropped the Fed rate 1/4 point. And now I've talked about this before, but just to be clear, if you haven't seen any of my other videos, the Fed rate does not directly impact mortgage rate. And when you know when the Fed does cut it, most times we don't see a dip. Sometimes we might actually see it go up a little bit because it's impacted by what after Fed said they announced the rate drop. And most times lenders already know a rate drop is coming. They've priced it in a week or two ahead of time into what their rates are. So we typically don't see any drop right after the Fed makes their announcement. But they are expected to probably announce another rate cut at the next meeting. And what that does affect is that will affect your credit cards, home equity lines, credit, car payments, things like that. It will affect those things directly, which does help affordability. And when you're qualifying for a home, if those things go down, that just means you're going to be able to qualify for more. So that's helpful regardless, even if the mortgage rate, your actual interest rate on mortgage doesn't go down. These other things go down that you're paying on monthly, that's just going to help you afford more of a home. So something good to keep in mind there. So that's where we're thinking, rates are probably going to keep ticking down. They're not going to have a huge drop. Hopefully they drop more than we expect, but we do see a slight decline going into 26 through most of 26 and into 27. Hopefully before too long we can dip below 6, but we'll see what happens there. And if you're a buyer looking to make a purchase in 2026, basically what you're walking into is prices are not falling off a cliff. They're going to hold steady or slightly go up. It depends on the area and the price range and the house. A lot of factors go into it, but we're not seeing any areas with a steep decline. Most are going to hold steady or even go up. We're seeing inventory probably increasing slightly, especially over where we are now in the holidays, but year over year, it probably will go up slightly. It won't go up a ton. And where we're saying rates, same thing, is probably ticking down slowly over time. They'll probably bump around, go down and then dip up and down. But overall, it will be a general decline as we go through the year. So if the prices aren't crashing and the inventory isn't going through the roof, then what does that mean for demand and buyer demand? And how is that playing into your search and the competition that you're going to run into? Well, that's what we're going to get into here in the next section. I'm going to talk about what's going on at the moment with buyer demand and where do we see it going from here. So as we talked about in the last section, prices aren't crashing. Inventory is up slightly, but it's still tight in some of the higher demand areas. And so what does that mean for the demand? Where is that going? Why is this part of this video? Well, what spurred all this was an article that I read in Housing Wire, and it said that housing demand is at the highest it's been in 3 years. And recent months, some weeks actually, we've been seeing double-digit increases over the previous year. It's kind of what spurred all this. We talked a little bit in the last section how the market was extremely slow back in the summer and that it had picked up. And so we've seen that as activity-wise with showings and offers and things like that, really seeing that. But now what we're seeing these last few weeks, really high increase in mortgage applications. So that's what they're saying. That's where they're seeing this, the demand. That's where they're gauging that, comparing mortgage applications from now to last year and then the previous years. We're at pretty much a 3-year high for mortgage applications. That means what are we looking at going into the new year? We're probably looking at a pretty high increase in buyer activity. And what does that mean for you if you're out there trying to buy a home, maybe now or moving into next year? That's what we're going to get into a little bit more here in this. First thing I wanted to touch on is really what drives that demand. And that is one of the biggest factors, which we hear about it all the time right now, is the interest rates. What's going on with mortgage rates? And that's what drives it drives affordability. And that's what gets people, even just mentally, it gets them to a point where, oh, okay, this seems manageable, even rate-wise. So I wanted to take a step back and just talk a little bit about some things that go into that. And one of the big factors of why rates are where they are right now, it has to do with the 10-year treasury. Look at that, and if you go back over time, the 10-year treasury, there's typically a spread between that and mortgage rates. And for years, historically, it's probably 50 years plus. Average has really been about 1.5% in the two. So what we've seen recently, these last 2 or 3 years, when rates have gone up quite a bit, is that spread has jumped up quite a bit as well. So not only are we looking at the 10-year treasury is higher than it was, add on a spread, which usually it's 1.5%, it's been right around 3%. So when you look at rates right now, we're around 6.5%. If that spread was where it should be, where it has been historically, and hopefully where we can kind of get back to, that's 1.5% higher. So that could be a 4.5% to 5% rate if that was at the actual spread of where it could be. Say we're going back to that anytime soon, and definitely don't get excited for the 3% rates to be coming back a very long time, if ever. But that does give us some cushion to see rates improve for that reason, even if there aren't a lot of other reasons that go into that. But some of the factors that go into that is what we're dealing with, and you're hearing a lot. A big factor really is inflation, economy, and jobs, and all that. And those are things that all go into this decision about what they're going to do about dropping rates. I just want to give some background, just so people are wondering, what can help rates go down. Get to the point. The reason that is higher than 1.5%, it's 2.5%, 3%, 2%, where that spread may be over where it used to be. It's really just based on risk. What do the lenders think is going on with risk, world, and the economy? All of those things, all that factors into. They want to give themselves a little bit more of a cushion, but it's just something I wanted to point out because it's not something that we all think about. When we're thinking, if the treasury goes down, then rates will come down. Yes. But just even if it doesn't, if we can get to where lenders are more comfortable with that, with the risk and what's happening in the world, which I don't think is going to happen anytime soon, but maybe they'll get more comfortable with it. And if they do, they reduce that spread a little bit. And that gives us cushion right there. That already gives us some room to see some rates possibly coming down just for that reason alone. So now let's stay on this topic with rates and affordability. And as a buyer, anyone looking, what buyers are thinking about is a lot of people don't buy from a lot of things they purchase. They don't buy, when I'm talking about a lot of things, even cars, buying a house, some people buy on payment, right? They're not buying on purchase price. Of course, we want it to appraise and we want it to be worth what we're paying for it. Most people, well, can I afford this on a monthly basis? And so that's what you really have to think about. That's what's driving the demand right now, because we've seen a little bit of a drop in rates. The smart buyers are thinking, okay, rates are coming down. They're probably going to continue coming down slightly. What is that going to do to the competition? And we'll touch on that a little bit more. But it's where people are seeing affordability come in a little bit. But also other things they can do to help that affordability. There's different types of rate buy downs, and everything depends on different situations, depends on your situation. But always apply. But basically, the two different kinds is there's a temporary buy down. A perfect example is a 2-1, where for the first year, rate is 2% below where the interest rates are. The interest rate is a 6.25. First year, you're at 4.25. Second year, you'll be at 5.25, and then you go up to 6.25. The idea is you'll probably refinance out of that at some point soon. I've had clients that just bought 6 months ago, already refinancing out of that rate into a better rate now, and giving themselves hundreds of dollars. That's where you get into when you're buying on monthly payment. You got to figure out, okay, increase the budget, or do we need to, if we're not finding what we want for at the price we want, is there a way to increase the budget? Do we do some type of buy down? The second type of buy down is a permanent one, where you say, okay, I'm going to pay so much at closing, and I'm going to get a quarter of a point off, and it's permanent. I recommend that these days because you pay that money, and when you refinance in six months, money did you no good. Usually it's many years, 5 to 7 years break even. Money you pay to get that lower rate for you to get your money back on it. The nice thing about the temporary buy down, just on a side note, if you pay the money you pay to get that temporary buy down, it doesn't go away. So if you refinance, actually you can use that to pay for the refi. But if you get a low cost refi, all of it or any that's extra can go towards the principal and actually pay it down. So the money, the credit you use to buy the temporary buy down, you don't lose it in the permanent buy down. I think that's something that's really nice to keep in mind, and you want to look at that. So the other things we're thinking about, we could say thing that would help you increase your budget, maybe buy down, maybe you can save money otherwise, or you might have to look at a different type of property, a different area, something that might need a little bit more work, like that. The other thing I wanted to touch on, this was really important. I just had a client that closed a home because of this, and they weren't even thinking about it. And most people don't. Right now, her situation was she was selling a property. That's when this comes into play. If you're selling a property and you look at all your monthly expenses, if you have credit card debt, personal loans, these loans that now are high interest rates. Credit cards are 25 to 9%. They're up there. Car loans, student loans, whatever it may be, personal loans, high interest rate. You can take some of those proceeds from your sale, you pay that down instead of putting it all towards the new purchase. Actually going to, if you look at your overall monthly debt number, opposed to just looking at your mortgage payment, this client, of course, her mortgage payment was higher. It was a higher interest rate. When she looked at her overall monthly outflow, reduced the other personal credit by hundreds of dollars. Her mortgage payment was hundreds of dollars more. It really was almost a wash. I don't know that she ended up monthly paying that much more than she would have been. Anyway, so that's something to think about. Are you improving your overall monthly debt situation, even if you are taking on a higher interest rate? Because with a mortgage, it's a lower rate, obviously, even though it's higher than they have been. It's still way lower than a credit card, and it's amortized out over 30 years. So it's going to, that monthly outlay. That's something to think about if you haven't help you run those numbers. I've got a really good lender that can run those numbers as well very quickly. I'm just kind of give you a sense of where that's at. Now back to the buyer demand conversation. So I touched on this earlier in the market update part, so I don't want to go too deep on it, but basically what we're seeing is demand's increasing. Like I said, rates have dipped a little bit, affordability's gotten better. We definitely are seeing it on the ground here locally with buyer activity, more people at open houses, more buyers reaching out to us saying, hey, I'm ready, or I'm thinking about it. So that, seeing the article that I mentioned earlier where loan applications are up at a 3-year high, not surprising. We're seeing it on the ground. And then that's a national stat or a national number. That's, everything that you got to tie back locally. And that's what we're seeing here in the Los Angeles market, is that activity is definitely coincides with what they were saying. So like I mentioned earlier, the buyers, they're seeing that and they're experiencing it as well too. You're in open house, you see lots of people maybe make an offer, there might be another offer or two, you don't get it. That's different than it's been for the last few months. So people are seeing that and they're thinking, well, if that's going to continue, it's only going to get more competitive. It's going to get harder to get offers accepted. It's going to get harder to negotiate. You're going to have to do lower timeframes on your contingencies. You're going to have to waive more contingencies. These different things that play into a little bit more challenging of an environment. So the buyers that can get in now, when the right home comes along, you can afford it into something that you're happy with. And I always say, let it go by. You're buying for at least a lot of people 5, 7, 10, 15 years. So if the right home comes along now, don't wait. Go after it. Don't overdo it. Don't wait just because you want to wait and you think rates might be a 0.25% lower later. That's not going to put you in a much better situation. So that's what we're touching on there. The other thing that comes into the demand, and that a lot of people don't think about as they're looking at homes, so that's why I want to bring it up now, because it comes into not just the demand, but it comes into the affordability, which heavily plays into the demand. And that's where we are on insurance costs these days. So getting homeowners insurance. That's what I'm going to jump into here next. So stick around. Okay, so let's get into the insurance conversation. And why does it matter so much now? Whether if you bought a home in the past, you probably know it didn't matter that much then. I've helped lots of clients over the years buy homes, and insurance was basically an afterthought. There was no doubt you're really going to get it as long as it was a pretty straightforward home in a normal area. But we just at the end of the transaction, we're just like, hey, make sure you get your insurance. And people did. They got a few days before they had their insurance person send it over to escrow, and all got handled. It was easy, but that's not the case anymore. Now we're dealing with insurance that For one, it can be difficult to get. They can be more strict on the types of properties, and it can be really expensive depending on what it is or where it's located. We even had situations where, like farmers, for example, they would only give 8,000 policies a month in the state of California, and those were used up pretty much in the first week. All the wildfires and everything that's been happening, insurance companies, their rates are higher, and it's something that we're telling buyers immediately. Once you get an offer accepted, within the first few days, you're saying, get with your insurance person right away. And so you got to do that. But then even when they do that, now there's extra things the insurance person's going to do. Usually in the past, they would say, oh yeah, here's your quote, send it over to escrow, and we'll lock in your policy. And now they're going out and they're asking for inspections. They're going out and looking at the home. So these are things to think about with a buyer. You may take on something that's, you have an electrical panel you're looking at that's a Zinsco or a stab lock. You might as well just start getting a bid from an electrician right away. Those are old panels. They historically have issues, and the insurance company is going to want you to replace those. But they may not at closing, but they're eventually going to find out about that, and they are going to ask you to replace it in order to keep coverage in place. And the other thing that a lot of buyers aren't aware of, a policy may get issued, and the insurance agent might look at the inspection. They might even go out and look at the house. They're going to look at the roof. They're going to look at, are there trees hanging over on the roof? What's going on? So they're going to look at a lot of different things. And the age of the roof is another thing they could come back on later. There's some water features that you can add to the property that they're going to start probably requiring. And either way, they're good features to add. So I'm going to touch on that a little bit. But they're going to go out and look at these things. And what the surprising thing to some buyers is, they'll issue the policy and they can come back after closing and say, hey, we now notice that. I think they have like 45 days. They say, hey, we noticed that panel was 60 years old and you need to get that replaced in the next 45 days, or we're going to cancel your insurance. You're going to have to find something else. You're going to be stuck without it. So that's something you definitely want to be aware of. And if you're in a high fire hazard zone, it's going to be even more challenging. There's a California Fair Plan, which is much more limited and more expensive. There's riders and things you can add onto it. So all of this is not meant to be advice. I'm not an insurance person, just like legal and financial advice. I pass you over to the professionals. This is just me giving the information, educating you, talking about things that you should be aware of, that you need to reach out to these professionals and talk to them about. So you definitely want to, everything I just mentioned there, you want to talk to your insurance person about that, or if you need one, you can reach out to me. But this is something I want to talk about because not only do you need to jump on it quicker these days, it's more expensive. So you need to make sure you're factoring the right insurance cost into your affordability and your comfort level. The lender might be using the right numbers, but it might not be taken, and it might work for your qualifications, but it might not work for your comfort level. I've had many clients that qualify for actually more than they were comfortable spending. So that's two different conversations. What do you qualify for, and what are you comfortable spending? A lot of my clients have actually not wanted to spend as much as they could qualify for. So that's the other thing you got to pay attention to. So when you're getting your qualifications and you're getting those quotes, definitely look at that. And so that you want to factor the insurance cost into that, of course. And on the wildfire part of things, if you're in a high fire hazard zone or an extremely high fire hazard zone, and you'll get a natural hazard disclosure, which will tell you those things, so you'll know. That's where you want to look into, and what you're going to need to be aware of buying the home is there's something called defensible space and fire hardening. So there's defensible space, there's different buffer zones. There's a tight area around the home, and then there's an expanded area where you just got to keep brush down. You got to keep things away from the house. You're just helping reduce fire risk. And then there are things you can do to the home to help fire as well. So those are things, I'm not going to get into the details of every little bit of it right now, but those are things you want to be aware of, you want to think about. And those high fire hazard zones, that's where you're actually going to, it's going to be a discussion during escrow. These are the things, does the home need certain things done? Is the buyer going to do that? Is the seller going to do that? It comes down to a negotiation. So that's where you just need to be aware of that as well, and be prepared going into that. If you're looking somewhere like Palos Verdes, the high fire hazard zone, you are going to run into those conversations. If you're in other parts of the South Bay, say, Torrance, Redondo, a lot of those areas are not typically high fire hazard. So you obviously want to look at a natural hazard disclosure report when you get it to make sure, but you typically don't run into that as much in those areas. So that's just something to keep in mind. If you are looking somewhere like Palos Verdes, you're going to have some of that those extra defensible space and things to look into when you're doing your inspections. And if you like my wildfire and systems checklist from my insurance person, then check out the description here in the video. There's a link to it. You can just grab it over there. Well, that's a wrap on the insurance section. So hopefully you enjoyed this video. If you want to learn about any other local areas and any other information, there's a link to a few different videos in the description of this video. And there's another video right here on your screen. So go check it out. And thanks for watching.